Have you ever wondered where money comes from? Most of us probably think of a government mint, printing presses churning out crisp banknotes and coins. While that's part of the story, it's a very small part. The shocking truth is that most of the money in our economy is uncreated by the government at all. It's created by commercial banks. It's the same banks where you have your checking and savings accounts. And they do it every single time they issue a loan. This might sound like a conspiracy theory, but it's just how our modern financial system works. Stick with me and I'll break down this mind-bending concept in simple terms, explaining how this money creation happens, what keeps it in check, and what it means for all of us. So how does a bank create money out of thin air? Let's bust a common myth first. Many people believe that banks are just intermediaries. You deposit your savings, say $1,000, and the bank then lends that same $1,000 to someone else. This is a simple, intuitive idea, but it's not accurate. The reality is far more interesting. When you go to a bank for a loan, let's say a $100,000 mortgage to buy a house, the bank doesn't pull that money from someone else's savings account. Instead, it simply types the numbers into your bank account. Poof, $100,000 appears, created with a few keystrokes. You can now use this new digital money to pay the seller of the house. Congratulations, you have a house, and you also have a debt to the bank. But more importantly, $100,000 of new money has just been added to the economy. This new money is a liability for the bank at S, your deposit that you can withdraw. But it's also an asset for them it's S, the loan you have to pay back with interest. In essence, loans create deposits, not the other way around. Every time a bank approves a loan for a car, a business, or a home, it is simultaneously creating new money. Now you might be thinking, if banks can just create money by typing numbers on a screen, what stops them from creating an infinite amount of it? Why don't they just give everyone $1 million loan and cause hyperinflation? This is where the limits of the system come into play. There are several powerful constraints that keep money creation in check. The first and most important one is profitability and risk. Banks or businesses only create money by lending if they're confident the borrower will pay it back with interest. They conduct credit checks and risk assessments. If they lend recklessly to people who can't repay, they won't get their money back, and they'll go out of business. Bad loans are a direct loss to the bank's own capital. So, the primary limit is their own self-interest and survival instinct. They need to find credit-worthy borrowers. The second major constraint is regulation, specifically capital requirements. Regulators require banks to hold a certain amount of their own money, called capital, as a buffer against losses. Think of it as the bank having some of its own skin in the game. For every dollar they lend, they must have a certain percentage of capital set aside. This means a bank can't expand its lending infinitely. Its ability to create new money is limited by the amount of capital it holds. If a bank wants to lend more, it needs to increase its capital, either by retaining its profits or raising funds from investors. This capital requirement acts as a direct brake on lending. A third factor is interest rates, set by the central bank. Like the Federal Reserve in the US, when the central bank raises its key interest rate, it becomes more expensive for commercial banks to borrow money themselves. They pass this higher cost on to their customers in the form of higher interest rates on loans. When loans are more expensive, fewer people and businesses want to borrow. Demand for loans goes down, and so does the rate of new money creation. Conversely, when the central bank lowers rates, borrowing becomes cheaper, stimulating loan demand and increasing the money supply. This is the main tool central banks use to manage the economy, either to cool down inflation or to stimulate growth. Finally, there's the behavior of the public. Banks can offer all the loans they want, but if no one is confident enough in the economy to take on new debt, then no new money is created. If businesses are pessimistic about the future, they won't borrow to expand. If individuals are worried about their jobs, they won't take out mortgages. So, the overall economic climate and public confidence play a huge role in how much money is actually created. So what are the broader implications of this system? Well, it has some huge benefits. Because money is created when people want to borrow for productive purposes. Like starting a business or buying a home, the money supply can dynamically expand to meet the needs of a growing economy. It's an elastic system. It doesn't rely on finding more gold or printing more paper. This flexibility can fuel economic growth and innovation. When the economy is booming, more loans are made, creating the money needed to support that boom. However, this system also has significant downsides and risks. It's inherently pro-cyclical, meaning it amplifies both booms and busts. During good times, optimism is high. Banks are eager to lend. Asset prices like stocks and real estate go up, which makes people feel wealthier and more willing to borrow. This creates a feedback loop where more lending leads to higher asset prices, which leads to more lending. This can create unsustainable bubbles. Then, when the sentiment turns, the cycle reverses. Asset prices fall, borrowers default on their loans, and banks suffer losses. In fearing more losses, banks drastically cut back on lending. This is called a credit crunch. The money supply shrinks, and a recession can become much deeper and longer than it otherwise would have been. We saw this play out dramatically during the 2008 financial crisis. Another major implication is the link between money and debt. In our system, virtually every dollar in existence is someone's debt. For money to be created, someone has to go into debt. This means that for the economy to grow, the overall level of debt in society must also grow. This raises long-term questions about sustainability. Can we really have an economy that requires ever-increasing levels of debt to function? And what does this mean for wealth inequality? Since new money enters the economy through loans, those who have assets to borrow against the wealthy are often the first to benefit. They can borrow cheaply, invest in assets that appreciate and grow their wealth, while those without assets are left behind. Understanding that banks create money is a fundamental shift in perspective. It reveals that the financial system isn't just a neutral plumbing system for the economy, it actively shapes it. The decisions made inside private banks, who gets a loan and for what purpose, have profound consequences for all of us. It determines which businesses get to grow, which families can buy homes, and whether our economy is stable or teetering on the edge of a crisis. This isn't some abstract economic theory. It affects your job, your savings, and the price of everything you buy. It's the hidden engine of our modern world. Recognizing this is the first step toward having a more informed conversation about how our economy should work and who it should work for. Thanks so much for watching. If you found this explanation helpful, please hit that like button and subscribe for more deep dives into how our world really works. Let me know your thoughts in the comments below. See you in the next video.